Hi friends, my name is Rahul Jain. I'm a SEBI registered research analyst. If you have a mutual fund portfolio, this is an extremely important video for you. Why? Because right now market is extremely volatile. One day Sensex is up by, let's say, 1000 points. Another day Sensex is down by 1000 points. Market is extremely volatile, and in the extreme volatility, if you make these three big mistakes on your mutual fund portfolio, then you might end up losing lakhs of rupees in your mutual fund portfolio. I myself have made these mistakes in the past, have learned my lesson, and I want to share all that lesson with you, practically showing you data, showing you examples so that the concepts are extremely crystal clear to you. If you're new to my channel, consider subscribing now. With that, let's move to mistake number one that you should not make. The first biggest mistake that people make in their mutual fund portfolio is to exit a mutual fund when it is down without doing any analysis whatsoever. They only look at the price drop. That mutual fund is down by, let's say, 15%, 20%. Let me exit it. This is a very, very bad mutual fund. Actually, that is a very, very big mistake if you have not done your analysis. Let me give you a practical example right now that is going on in the market so that you practically understand it. I'm going to take an example of Motilal Oswal Mid Cap Fund Direct Growth. You all are aware of this particular fund. Very, very outstanding performer when you talk about 5-year or 10-year. Okay. For example, if I talk about December 2024 here, okay, the NAV of this mutual fund was all-time high at around 130. I'm talking about the direct mutual fund here. Everybody was gaga about Motilal Oswal Mid Cap Mutual Fund. Why? Because last few years this has given outstanding returns. In fact, if I show you the data, here is the fact sheet of this mutual fund as of September 2024 when the NAV was at the all-time high. What do you note here? That in the last 1 year, the mutual fund gave additional benchmark returns of 32.80%. This is huge outperformance. Look at the last 3 years outperformance, 14.92% yearly. Okay. Look at last 5 years, 18.95%. So this fund up until December 2024 was doing miracles. You go and talk to anybody, everybody will say to you that buy the Motilal Oswal Mid Cap Mutual Fund. That was the narrative at that time because the fund was performing very, very good. Now let us imagine an investor. If you bought this fund or started investing in this fund at this 120, 124, 130 sort of a NAV because you did not know market can correct. Nobody really knows the market can correct. But since September 2024, when the market started to correct, what happened? Of course, the fund also started to correct. Now, come almost, let's say, April 2025, the fund's NAV dropped to 98. Now, somebody who bought this fund at around 130 almost lost 24% of the value. And this is where the panic will kick in. All of a sudden, this is underperforming. People will blindly exit it without looking anything and they will incur losses. I don't want you to do that. Why? Because look at what happened afterwards. In just a few months of time, the NAV went back to almost 120 level, right? So you could have exited at that level if you really wanted to exit. Of course, I'm not saying you exit it, but before you exit, at least analyze 4 parameters that I'm going to run you through using this as an example so that practically you understand it. You can apply the same framework to any mutual fund that you hold in your portfolio, which is possibly right now down maybe 10%, 5%, 20%, whatever that number is. So the first parameter we have to look at is mutual funds long-term performance, okay, because this underperformance is for short-term, right? So for long-term performance, have a look at the 5-year average rolling returns. Now, what is the average rolling return concept? I explained to you in my this video, Achhe Mutual Funds. It was in Hindi. If you have not yet subscribed to my Hindi channel, please do so. You're going to learn some concepts in a practical manner. Right now, coming back to Motilal Oswal, if I look at last 5 years average rolling returns, it is still at number 1. Okay, what does rolling returns means? That if you look at any 5-year block, has the fund given good returns or not? And as long as your mutual fund is in top 5, then you are fine. It means the fund has given long-term outperformance, right? Underperformance is there in the short term. We need to understand the reasons for it. But at least from a long-term perspective, your fund has done phenomenally well. Now, the second parameter you need to check about that mutual fund is the nature of that mutual fund. What do I mean by nature of the mutual fund? So what I've done is, for making this concept clear, I've taken 5 mid-cap mutual funds, okay? And here you see the number of stocks they hold. Okay, so Motilal Oswal 27, HDFC 77, Invesco 42, Edelweiss 89, JM 63. Now what do you note here in terms of the nature of mutual fund? You'll very quickly see that Edelweiss has 89 stocks, HDFC has 77, very high, and Motilal only has 27. What is the nature of these mutual funds? Motilal is a highly concentrated mutual fund. They pick only few stocks out of, let's say, 150 mid-cap stocks, which is stock number 101 to 250. It means the nature of the mutual fund is this is a high risk and high reward. Why? Because if the bet on these 27 stocks does not play out, the mutual fund might underperform. But if the bet on these 27 stocks comes out really well, then the mutual fund is going to outperform the market. And we saw this outperformance back in 2023, 2022, 2024. You can see the data yourself, where the mutual fund did exceptionally well as compared to the benchmark. On the contrary, if you look at HDFC Midcap Fund, they have 77 stocks. How many mid-cap stocks we have? 150. Out of that, they have selected 77, meaning that the mutual fund manager is not taking high risk there, okay? And therefore, the returns you are likely to see is going to be very similar to index. It's gonna fall into a range of the index returns. Likewise, Edelweiss, 89 stocks. No offense to Edelweiss here, but if I'm paying a mutual fund manager to pick stocks out of 150, if they're picking 89, are they really doing a good job? I might as well invest in the mid-cap index fund in that case. That is my theory. You might say that, Rahul, that's okay. We want to stick to ones that are not very high risk, high reward. And that is the analysis you need to do before you enter into a mutual fund. But at least now you understand that, you know what, this mutual fund is highly concentrated, high risk, high reward. What do I do? At least you have understood the reason. Now comes the third factor, which is actually understand the reason for this correction. Okay, fine. They have selected 27 stocks, but what has gone wrong here? So for this, I'll show you some data. For example, if you look at the September 2024 fact sheet, at that time, they had IT allocation of around 20% in their portfolio, right? Very high concentration of IT stocks. IT stocks at the time were doing very well. This was working out for them very well. But what happened? Market started to correct sharply, and more than market, IT stocks started crashing. We all know what happened to IT stocks, and hence the mutual fund NAV corrected more than the benchmark, more than the overall broad market, right? Now, after analyzing this, what you need to simply do is go to their latest fact sheet. Okay, you can find that on their website and try and find out if they're still on 20% on the IT. Because if they are, that means they're still carrying that risk. Okay. For example, here I looked at their recent fact sheet of 2026, and what I see is that their IT software allocation has dropped from 20% to 12.5%. In fact, they have added capital market, which is 12.9%. And you see there is now more evenly distribution of the sectors here versus what was there in previous. So they have sort of de-risked the portfolio. This is how you need to see whether the mutual fund have cut down the risk or not, right? Again, if they have cut down the risk, then it's fine, because mutual fund manager is now changing the approach. And potentially this strategy is better suited to the current market conditions, because IT stocks are still beating down almost on a daily basis. Now comes the fourth parameter, which is to check for any changes in the mutual fund manager, because mutual fund manager is the soul of a mutual fund. Okay. Now, in the case of Motilal Oswal Midcap Fund, if you go and read on internet, you will find that Niket Shah, who used to be the fund manager earlier, he was moved on and he moved to some other roles, and new fund managers have come in to replace Niket Shah. For example, here in their fact sheet, you will find Mr. Ajay Khandelwal is there now, right, which has got 18 plus years of experience. Varun Sharma is there, which is 15 plus years. Ankit Agrawal, more than 20 plus years. Now you need to really assess that the new mutual fund managers, do they have the right experience or not? So for example, here they have 20 plus years experience, 18 plus years of experience, 15 plus years of experience. So definitely experience wise, they seem to be covered here. But please understand, any new mutual fund manager that comes into a mutual fund, they're going to take time. You need to give them at least 3 to 4 quarters of time, minimum 3 to 4 quarters, for them to get used to the fund and start outperforming the market. And even then, after 3 to 4 quarters, if you feel that, you know what, the fund is not going anywhere, then of course you've done all your analysis. At that time, make the call to at least stop your SIPs or lump sum investment, move your money to any other mid-cap mutual fund or any other mutual fund for that matter, if you like that. But please do not make the mistake of blindly exiting a mutual fund. Go through at least these 4 parameters, and I'm sure you will know your answer either ways, whether you need to exit the mutual fund or not. But don't book your losses something like, you know, selling your mutual funds at 98 NAV, or even after that the fund dropped to 92. If you sell this mutual fund at 92 and 98, surely you're booking losses. But see what happened, within a few days back, it recovered back to 108. Now again, it is falling slightly as the market has fallen down. Therefore, please look at these minimum 4 parameters and I'm sure you will come out with a good answer whether you should exit your mutual fund or not. So this was mutual fund mistake number 1. I know slightly we took a little bit longer here to explain to you practically, but now let me move to mistake number 2 and mistake number 3 very quickly. Second big mistake investors make is to chase the momentum. For example, recently I was reading this article on Economic Times that defense mutual fund surged up to 25% in a month. Should you invest now or wait for a correction? Now this is a very rosy headline that comes out in the media and a lot of people get carried away. They think that, you know what, defense is going to be a very good theme because the wars are happening, this, that, and they will go and buy lump sum in a defense mutual fund without even understanding what is the index this is following, what are the valuations. So at least look at 2 things. What is the index this particular mutual fund is following or the category is following, and secondly, what are the current valuations. So for example, if you look at Nifty India Defense, which is the index that tracks the defense sector, and come down here, you see the type of sectors or the industries it has. Okay, aerospace and defense is 56% here, and if you further go and expand this, you will see the companies like HAL, BDL, Data Patterns, GRSC, BEL, etc. Right? At least you get a sense of what type of companies are included in this particular index, so that you understand the concentration of these particular companies. Okay, very important point that people ignore, right? Second point is to look at valuation. So for example, if I show you here Nifty India Defense PE ratio right now, very simple metric of PE ratio 56. Okay, now compare this with the 5-year average PE ratio of this particular index. What is the 5-year average? 43. Right now it is trading at around what? 56. Should you buy this or not? The answer is very obvious in front of you, right? If you look at 6-month PE range, 2-year PE range, 1-year PE range, this is tracking at all-time high valuations, right? Now the question is that should you wait or not? So for example, if you come back here and look at the green line here, which is showing you the PE ratio, back in 30th of March, the PE ratio of this particular index was only 45. Right? Now it is at around what? 56. Should you buy it right now? No. There is absolutely a possibility of the valuations to correct in the short term. And maybe that is the time that you would like to take an entry if you're really keen on the defense theme, right? Now, even if you do not listen to me, you say that, Rahul, you know what? Defense is a very good theme. Wars are happening across the globe. This is likely to do well. Fine. Understood. At least make sure that you're following to 3 principles. Principle number 1 is that do not allocate more than 5 to 10% of your mutual fund portfolio in thematic mutual funds. They are very risky. You really need to understand when to enter, when to exit. That is point number 1. Point number 2, do not do lump sum investment in sectoral or thematic mutual fund. Stagger your investment out, let's say to 6 months or 12 months as a minimum, so that you're buying at an average price. And third one is that if you are taking any bets into a sectoral or thematic mutual fund, please track that sector, at least understand the nuances of what's happening, what the Indian government's policies are, what sort of restrictions are being put on to import export. Those basic things if you understand, then you are likely to make a better decision in terms of entry and exit of these mutual funds. So this is the mistake number 2, that a lot of people chase the momentum without looking at valuations, without looking at what is going on in that sector and theme. Please don't do that. You're going to lose a lot of money. You're not going to make any money. With that, let me move to mistake number 3, which sounds very simple. But you know what, a lot of people are making this mistake, so I have to say it out to you loudly. Third big mistake that people make when markets are not great is they stop their SIPs, they pause their SIPs. We know that last 2-3 years, Indian stock market have not given great returns, and that's why a lot of people are pausing their SIPs, not doing their SIPs, etc. I want you to have a look at this chart. What you see is 2 investors here. Blue line is showing you investor A and red line is showing you investor B. What is the difference between these 2 investors? Investor A, which is the blue line, invested 10,000 rupees per month since 2008 uninterrupted. No break in SIPs, continue to put SIPs from 2008. While investor B, what this investor has been doing is that whenever market index falls by, let's say, 15%, this investor stops the SIPs and wait for the market to recover, because this investor is panicking by seeing 15% fall. So when market comes back and recovers back to the original level, then this investor will put the SIPs, resume the SIPs, and whatever has been the missed SIPs, he will put that in a lump sum. Right? That's what the strategy have been. And if you look at the final outcome of investor A and investor B, you will find that investor B has created 15% less wealth as compared to investor A, simply by just trying to time these SIPs, trying to do something different in the market, and that's what has caused him less wealth, 15% less wealth as compared to investor A. Please don't do this mistake of pausing your SIPs. SIPs are meant to be giving you average buy. For example, here look at 10,000 rupees SIPs, right? When the market is very high, NAV of the mutual fund is 110, then you're getting only 90.9 units, right? But when the NAV drops to 90 as the market falls, you're getting 111 units of that mutual fund. It is the basic concept. A lot of people are still making this mistake, so I had to sort of talk about this. And last picture I will show you is, you don't know when the bull run will start. I don't know, you don't know. And if you miss out on the best returns that the market is giving on few days, you will lose the wealth creation opportunity. Here is the data for you. If you miss the 15 best days in the last 25 plus years, then your portfolio is down by almost 66% in terms of the wealth creation. Don't do this. Remain invested, continue to do your SIPs for long term. Cut the noise out. A lot of people are saying Indian markets will never give you returns, etc. This has happened in the past, that market was sideways for a long time, but eventually markets bounce back. That's what I have seen in my investing journey, and I hope you also witness that very soon. I hope that very soon we see bull market in India, so that the confidence comes back with the SIP investors. So these are the 3 big mutual fund mistakes that you should not be doing. Share this video with your friends and family so that they also understand this practically, that they shouldn't be making these mutual fund mistakes. If you have not yet subscribed to my channel, hit that subscribe button now. Let me know in the comments any mutual funds that you're struggling with, and at least start sharing your analysis in the comment section. Your comments are always appreciated. Drop a thank you. It will motivate me and my team to bring such content for you at zero cost. Also, just an announcement that I will continue to make videos on 30 stock series that I talked about. More than 2,000 people commented on that video. So I'm going to release every month almost one video on 30 stock series, so that you get good insights about 30 good companies in India. With that, I'm going to see you in my next video. Until then, keep rocking.